well, we have Jay Powell. Actually, much better than Jay Powell. Here's what we have. John Carney, Breitbart Economics and Finance Editor and co-author of the Breitbart Business Digest, which is a must-read. Okay, we're going to put in Steve Forbes here in a minute, but John, what? Go ahead. Tell me how great Jay Powell was today. Well, he didn't mention, it's not like, I don't want to be like some friends of mine and ask a question and give you the answer. But the fact is, he never mentioned the oil spike, which is an oil shock, except when our reporter, Edward Lawrence, who's a very smart chap, clever chap, asked him about it, and then gave the stupidest, goofiest answer I've ever heard. Now,
I was glad he got asked about it. This is absolutely a very important thing. It affects not just the things made of oil, but it affects the money people have to spend on other things not made of oil. Okay. If you're paying up for the gas, for gasoline, that means you don't have the money to spend on a concert ticket or a movie ticket. It is a tax on Americans. Joe Biden loves that, by the way. He wants there to be, in effect, a tax on Americans in the form of high gas prices, because they have a religious fanaticism about hating the production of fossil fuels.
Can I play this? Let me ask my producers. We're rearranging the deck chairs here a little bit. Bear with me. Can we play the Jay Powell answer just one more time? I want to make sure my pal Steve Forbes hears it, and I want it to be embedded into John Carney's mind. Here it comes. Here comes Jay Powell, goofy that it is.
We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that and don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation and things like that. That's just things we have to monitor.
All right. Steve Forbes, founder and editor-in-chief of Forbes Media, my dear friend for so many decades. Oil prices, energy doesn't affect where inflation is going.
This reminds me of the early 1970s when we had a terrible...
Just 100%. Sorry, don't mean to interrupt.
When we had a terrible inflation.
Yes.
Stein, the head of the Council of Economic Advisors, had a bad report. So what he went out and said with a straight face, if you exclude copper, if you exclude food, if you exclude housing, and this, that, and the other thing, 7 items, it looks pretty good. It took a while for the reporters to get onto it that he was pulling their leg. Powell's not pulling their leg. He's serious about this stuff.
He was serious.
It's inflation. If you exclude everything that went up in prices, you have no inflation at all.
I mean, here's the thing. The inflation rate is averaging now for the 3-year period, something around 5%. Okay, I'm just going to toss that number out. More or less 5%. 3 percentage points above where it ought to be, which is 2. Some would say 5 percentage points above where it ought to be, which is 0. But, one of the constants here is high energy and gasoline.
And the Biden administration already spent all of the literal capital that they had to deal with this problem by releasing all of the strategic petroleum reserves. There is not a ready source of oil now that can be tapped to bring down prices. So when Jay's saying, it can be volatile, it went down because we manipulated the market by flooding it in front of the midterm elections. That was very intentional and very political by Joe Biden. Guess what? They can't do that this time. They just don't have the reserves to do it. He's going to end up filling the reserves with $100 a barrel oil.
$125 a barrel. Yeah, what happened? They were going to bill it when it went under 70, but they forgot.
Well, it was actually a huge betrayal because the Saudis said, okay, look, fair enough. You don't want it at 125. But you need to put a floor on this, fill it up when it gets to 70. They didn't do that. The price kept going down. Now we have no friends who produce oil around the world. And in the U.S., people are afraid to invest in it.
No friends who produce oil. That's such a key point. OPEC Plus, full of our enemies or adversaries or whatever you want to call them. Steve Forbes, I don't want to belabor the point, but you were getting... This is 19. I don't know whether this is exactly like the 70s, but it has certainly around the edges.
It rhymes.
It rhymes. Thank you. Very good. And one of the things we learned, which Volcker taught us later, when you get these commodity spikes, in this case, energy spikes, the Fed should tighten. If energy falls, the Fed should ease. You don't want it embedded into the inflation rate by so-called monetary. You don't want to print money that embeds it into the economy forever, which brings me to a broader point. This is a Steve Forbes point. The commodity value of the dollar, the gold value of the dollar, I use the CRB, which includes, as you know, gold and silver, is falling. We have the chart. If we can run that CRB chart again, the last 5 months, 4, 5, 6 months, we've seen a big rally in commodity price. There it is, CRB commodity index gone way up. Some of that's oil, a lot of it's not oil. Between that and the energy problem, look, I don't want to see high interest rates either, but they screwed up so much in recent years, they're kind of stuck with this, and they're talking about pausing. Just get it done. Get it done as fast as you can. You're going to have to raise the rates. Just get it done and get out of the way.
If Powell had a backbone and wanted to immolate himself, what he would do is go out and say, high oil prices produce more oil. We can't get more oil by raising interest rates. We can suppress demand, but we can't produce more oil. Well, that's beyond our competence. So get your policies right, and some of these things will take care of themselves. We already saw a few years ago, oil prices went down, natural gas prices went down, huge market in Europe for natural gas. Do those things. Don't depend on the Fed. We can only do so much. And the thing is, the Fed is now playing a little game. They are reducing so-called reverse repos, which once were $2.5 trillion. In effect, they borrow short-term from banks and money market funds. That's now down to $1.5 trillion.
Why is that, Steve? Why is that?
Because they're reducing their balance sheet without raising interest rates.
Oh.
That's what they're doing.
Is that, that might not be a bad thing.
No, but Powell should lay it out.
Oh, yes, of course.
He should lay it out. This is what we're doing.
That's the real money supply. In effect, that's the basis for the money supply. And so they're doing the right thing. He just doesn't talk about it. Is that fair, John?
Yeah, no, I think that's right. The money supply, the money supply has come down. They should talk about that more. It's like so uncool though for central bankers to talk about monetary aggregates now. They don't like to do it. They want to talk about their expectations and their target rates and all that. They should talk about the monetary aggregates because that's actually the money in the system that is getting spent and that is pushing inflation high. I think Powell tried to say that his base case is not soft landing. If you look at what those projections say, though, they think growth is going to be up a lot more than they remember back in June. They said we were going to grow 1% this year. That's the wrongest forecast I've ever seen from the Federal Reserve. They now say we're going to grow 2%. Back in March, they thought we were going to grow 0.4% this year. They thought their interest rate hikes were going to bring down both the economy and inflation a lot more than they did, and it didn't happen.
But you know what? It's never over till it's over. I mean, I'm still looking at an inverted yield curve and the index of leading indicators.
I think the Fed might well find itself in a position that it needs to hike rates next year, which it is desperately trying to do. That's why they're going to hike in November, because they do not want to hike in an election year.
Why didn't they hike today?
They should have done it. It makes no sense.
Oil prices heading towards 100. They may go to 125. I don't know. I'm not smart enough to know. I'm just saying, just get it done.
Yep.
Get it done. Steve Forbes, give you the last word.
Stable dollar.
Yeah.
That takes care of the problem.
Yeah.
And then say, increase the capacity of the economy to produce. Reduce taxes, reduce spending. By golly, miracles will happen. And they'll look like geniuses. Why don't they get it?
Limits.
They only have 4,000 years of experience with this.
Limit spending. You're right. Lower taxes, lower regulations. Sound like Donald Trump. Wait.
Ronald Reagan, remember him?
Ronald Reagan. That's what Reagan did as well. Thank you, gentlemen. We appreciate it. Thank you for hustling on.